UK's largest renewable energy fund, Greencoat UK Wind, is currently trading at the biggest discount to their net asset value since their inception. Their juicy 7% dividend yield makes this a very appealing investment for investors looking to build a passive income. But is this dividend truly sustainable? And what is behind the huge discount? Are you also wondering if now is a good time to add UKW to your long-term investments? Well, in today's video I'll break it down. I'll look at the business models of UKW, analyze their position by doing a Porter's 5 forces analysis, and have a look at the latest financial statements. I'll also check the valuation to see if now is a good time to buy. So sit back, relax, and let's explore UKW's investment potential together. Today's video is a bit special because it was requested down in the comments. Thank you so much for your request, Dimitri. And if you have any requests for future analysis, please feel free to also leave me a comment down below. My name is Florian, welcome to Cashflow Maniac. The ticker symbol of Greencoat UK Wind is UKW, and they are listed on the London Stock Exchange. They are working in the financial sector because it's a fund, but I would also put them in the utility sector as a renewable energy fund. They were founded in 2013 and their fund manager is Schroders Greencoat. The market cap sits at 3.3 billion British pounds at the moment. Greencoat UK Wind was the pioneer in renewable infrastructure funds to debut on the London Stock Exchange and remains the only infrastructure fund or renewable infrastructure fund established in the UK as of today. The company is part of the FTSE 250 index and one of the largest positions in this index. They provide exposure to the UK wind generation through a vehicle listed on the stock market. UKW exclusively invests in operational onshore and offshore UK wind farms that already generate income. Their net power generation capacity now exceeds 2 GW, which is roughly 1.5% of UK's overall electricity demand and sufficient to power 2 million homes. Over the long term, the company's objective is to offer investors an annual dividend that increases in accordance with the RPI inflation while safeguarding the capital value of its investment portfolio in real terms through reinvestments and careful utilization of portfolio leverage. As an investment trust, there are ongoing charges of 0.92% of the net asset value. The business model of UKW is actually very simple. With the operation of their wind farm, they provide electricity that they sell to utility providers and they generate cash with this electricity. As first priority, this cash is used to pay the dividends of their investors, and as second priority, the remaining cash is reinvested right back into their business. The company also uses debt to leverage these investments in order to speed up this process. So, as owner and operator of these wind farms, UKW generates the electricity with the wind farms that is then translated to the distribution network via substation that they also own. And from these substations, they sell the electricity to large utility providers that basically deliver the electricity then to the end users, to the households or to industry clients. The wind generation market in the UK is a very interesting one. The map of Europe in the Global Wind Atlas shows that the highest mean power density in the wind is actually measured in and around Great Britain. The power density gives a better picture of the energy contained in this wind compared to the mean wind speed. That's why I use the mean power density here in this map. When we zoom into the wind map of the UK and compare it with the sites of UKW's wind farms, we see that most of these sites are located at very strategic positions. These are some of the best locations for wind farms you can find in all of Europe. Compared to many other locations, the mean power density of the wind in these locations is very high. The portfolio of UKW contains almost 50-50 onshore and offshore wind farms. In the past, they had a limitation offshore wind farms of 40%, but just last year they relaxed this limitation a little bit and now they are able to increase the percentage of offshore wind farms. Geography-wise, all of their wind farms are located in the UK and most of them are actually either in England or in Scotland. The mean asset age at the moment is at 7.5 years. The vast majority of operational turbines in their wind farms is either built from Siemens or from Vestas. These two parameters, asset age and turbine manufacture, will become important in just a little bit when we look at the potential long-term development of UKW's assets. But as the main driver of their income, let's first have a look at the forecast of the power market in the UK. And here the solid line is the forecast of the average power price in the UK over the next couple of years. And the dotted line is the power price that UKW is expecting to receive for their power. As wind power is a bit unreliable and unstable, and the customers have to basically buy it when it's there and not choose this power to use for the most expensive and the peak times in power usage, the price of wind power is actually a bit lower compared to the average power. We can also see that the power price is expected to decline over the long run, although the end of the expectation is 2016, so it is really the very long run. The price effects in the next 10 years or so is not that big. Even with this decline in power price, UKW expects that they can well cover the dividend. And in their calculation, they expect an RPI increase of around 3.5% per year. And that is actually also their target for increasing the dividend. They want to increase the dividend at least by a factor of the RPI. And with these estimations for RPI increase and power price decrease over the next 5 years, they are still expecting that the dividend is very well covered by at least 2 times. Even if the power price is a bit lower compared to the base case that we just saw, the dividend is still very well covered. The power price itself is also not their only income, because as renewable energy producer, they are able to sell CO2 certificates and other green benefits to other companies. The wind power is a very important renewable energy source in the UK because of this very high mean power density that we have in the country. Until 2030, the offshore wind capacity is expected to reach 50 gigawatt, up from the 30 gigawatt that we have as of today. So in the next 6 years, the wind capacity should almost double. As the biggest player in this field, UKW has a very good position to benefit from this trend. Unfortunately, the assets, the wind turbines that UKW is using, don't have unlimited lifespan. At the moment, the expected lifespan is between 20 and 35 years. That basically means that after around 25 years, the costs, the maintenance costs and the repair costs for such a turbine are too high so that it's not worth operating these turbines anymore and they have to be replaced. But the producer of these turbines are already working on life extensions by using more robust components or by finding and fixing the most sensitive parts in such a wind turbine. Not only are they working on life extensions, they are also working on performance improvements. So there is a good chance that the current expected lifetime of these turbines will be extended when we come to the end of these 20 to 30 years. And there is also a chance that the performance of the currently existing turbines is also further increased by either exchanging some components within the turbines or also by just operating these turbines in a slightly different way. The company is actually already using AI tools to determine the best operating point of their wind parks, so they can even increase the efficiency by a little bit. But the life of these turbines can of course only be extended so much, and by the end they still have to be deconstructed and recycled. At the moment only 80% of these turbines is recyclable. And as you can expect, these demolitions and recyclings are quite expensive. So UKW is already working with the University of Edinburgh and the Imperial College of London to determine how these turbines can be deconstructed and recycled in a cost-effective and environment-friendly way. For the analysis of the strategic position, I focused more on the operational side of UKW instead of the fund or trust side. First of all, I would estimate the threat of new entrants as low. There are very high capex requirements in the utility sector, and not only that, but there are also many regulations to keep track of, which increase this barrier even further. As first and largest green energy fund in the UK, Greencoat has the first mover advantage and can benefit from the economy of scale. The threat of substitutes I would also estimate as low. Renewable energy providers still have to compete against conventional ones, and there are many players out there. But the regulations and the plan to zero emissions still gives them quite an advantage position here. The competitive rivalry in this case is quite high. There is quite some competition going on in the renewable energy space, as most players are quite large and are fighting for market share. It is also quite hard to differentiate yourself in this power market, as it is highly regulated, which further drives the competition. The bargaining power of their customers I would estimate as medium. The power price is highly regulated, giving UKW, but also their customers, only a limited bargaining position here. As an essential product, their customers are dependent on electricity. And as biggest renewable energy fund in the UK, the fund itself has some bargaining power when it comes to negotiating interest rates and also new acquisitions. The bargaining power of their suppliers, on the other hand, is low. The profit of these wind park operators is directly linked to the purchasing price of these turbines. So suppliers have to provide the turbines at a reasonable pricing. And as there are several big suppliers out there for these wind turbines, their bargaining power is quite low. Overall, UKW is operating in a highly competitive and strictly regulated market here. And these regulations are essentially in place to limit the moat of each individual company in the sector. So I think that UKW, as the biggest wind player in the UK, has a strong position here, but the moat to their competitors is not overly huge. Before we come to the financial analysis now, if you do like the video so far, please smash the like button and consider subscribing to the channel in order not to miss my next video. The fundamentals of the company are a bit of a mixed bag. In terms of revenue and net income, the numbers are fluctuating around a bit and we cannot see a clear trend, even though in 2022 we have a huge outlier here and the net income as well as the total revenue have increased quite a bit. But in 2023 these numbers came back down again and the net income even fell back to levels from 2020. The two metrics I find most interesting for these utility companies is actually the operating cash flow and the earnings per share. And in case of the operating cash flow, the picture looks a bit different. Here, the trend is definitely pointing upwards, even though we can also see that in 2023, the value came back down a bit from the very high values we had in 2022. Earnings per share, on the other hand, is a totally different picture. Here, the trend is fluctuating around quite a bit, and even though we can also see this outlier in 2022, in 2023, we are on almost the lowest level ever. We find the reason for this low earnings per share when we look at the diluted shares outstanding. Since the inception of the company, the shares have increased by a very significant amount. Over the last 5 years alone, we had a share dilution of more than 17%, which is insane, even for such a utility company where it's more common to issue new shares. The share dilution is actually so big that I didn't believe the numbers that I saw in Tradingview. So I went back and dug out the company report from 2018 and compared the numbers to the last company report from 2023. Unfortunately, this just confirmed the numbers that I saw in Tradingview. And here we see the numbers outstanding in 2018 and also the earnings per share from operation in these years. So while the outstanding number of shares increased by more than double, the earnings per share decreased very significantly. I mentioned earlier that utility companies like Greencoat UK are actually using debt to leverage and quicker grow their assets. In case of UKW, they have a current total debt of 2.35 billion British pounds, which is a leverage of around 40% compared to the net asset value. And they have a self-imposed cap here of 40% leverage, or gearing as they put it here. So basically they have already reached the maximum leverage they allow themselves. I do like this cap a lot, especially in the current environment of increasing interest rates. Because of course, these leverages can increase the growth of the company, but on the other hand, they also increase the risk. At the moment, their weighted average cost of debt is 4.6%, and this went up around 0.5% only in the last couple of months. So with the higher interest rates that we see at the moment, we can already immediately see an effect on the interest rate payments of UKW. But when we look at the real numbers, we see that the interest rate payments and the amortization is still well below the operating cash flow. So at the moment, this seems to be well under control. It also helps that a lot of their debt will only mature after 2026. And over the next 2 years, the amount they have to pay back or refinance is not too big. So the company can just hope that by 2026, the interest rates have recovered a little bit again. But I would also assume that the interest rates will not come down to the same levels we saw over the last 10 years, which definitely will have an impact on the asset growth of UKW. So I would expect that they will not be able to grow the assets as quickly as they did over the last 10 years. When we check the past performance of the company, and in this case, I'm not comparing it to the S&P 500, but I'm comparing it to the Morningstar Renewable Energy Infrastructure Fund. So let me briefly explain what exactly we are seeing in this graph here. The dark blue area is the total return of UK Wind, the orange line, the net asset value of UK Wind, the dark green line is the performance of the Morningstar Renewable Energy Infrastructure Fund, and the light green line is the net asset value of the Morningstar Renewable Energy Infrastructure Fund. And over the last 10 years, Greencoat UK Wind could actually increase their net asset value quite a bit quicker compared to the net asset value of the Morningstar Fund. The total return of Greencoat UK in blue compared to the dark green line, even though it was a bit weak over the last couple of years, was still quite a bit stronger compared to the fund. But what I find most interesting here is, and let's remove the comparison for just a bit, we see that over the majority of these last 10 years, Greencoat UK was actually trading at a premium compared to their net asset value. And only over the last year, this has switched around, and at the moment they are trading at quite a discount. Down here in this graph, the AIC even states this discount, and we see that in the last 10 years, the discount we see as of today is the biggest that we ever saw. But why exactly is UKW trading at such a discount at the moment? I think there are a couple of different reasons here. First of all, with the rising interest rates, the risk-free rates that you can get have also increased. And this has especially put dividend payers like UKW under immense pressure. Second reason is that with the energy prices declining over the next decades, the value of UKW's assets will also decline in line with the energy price. And last but not least, just last year, we saw the quality problems reported by Siemens Gamesa with their wind turbines. And even though in my analysis, I couldn't find any direct effects on UKW with these quality problems, but still, as the Siemens turbines make up around 1/3 of the turbines used from UKW, there definitely is still a risk. An interesting side effect of this changed environment and this huge discount is actually that the company decided for the first time since their inception to not invest in new wind parks, but instead buying back shares from their own company. And even though I think this is quite a nice sign and an indication that the company might change their strategy when it comes to issuing new shares, I am still not convinced that they will keep this up also over the long run. So to sum this up, from my perspective, there are 3 points that speak for an investment in UKW right now. First of all, the high dividend yield of 7%, the low volatility, and the historically high discount to their net asset value. The company themselves is taking advantage of this discount by buying back shares, which has 2 positive effects at the moment. First, it will reduce future dividend payouts, and as the dividend payouts are a major cost factor for the company, this will definitely have an effect on their cash flow. And second of all, when buying back shares at a discount to the net asset value, the company is basically buying back these assets also with a discount. So the stock might be interesting for investors who either seek a high dividend yield and low volatility, or maybe for speculators who are betting on a correction to the net asset value discount. One of the biggest issues I have with the company is the insane stock dilution of over 70% per year for the last 5 years. And this is pretty high even for such a utility company. The dilution even was way higher than the dividend yield or even the total return of the company. I also think that the upside from a price appreciation point of view is limited by the net asset value, and with the recent shift away from the low interest rates, it will become more difficult for the company to further increase this. Because of this and the fact that I didn't even know the company before Dimitri mentioned it in the comments, thank you again for this, I am not invested at the moment. But please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching, guys. If you did find the analysis helpful, please smash the like button and consider subscribe to the channel in order not to miss my next video. And if you're looking for another company for your long-term portfolio, this one might just be the right one.